Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for February 7th, 2022. We are recording this at 1 p.m. Eastern Time, and this is the 330th episode of this series. My name is David Kosmeter. I'm the creator of Timing Research, and you should be seeing my screen today. And I'm going to pull up charts related to what we talk about throughout today's episode. So today I've arranged for Erik Gebhard and Michael Filighera to join us. And the option professor is back to moderate. So I'm going to go ahead and turn it over to him.
Great. Okay, guys, we have a big day here on a Monday morning and a lot of action last week, that's for sure. And we're starting out with some volatility here today. So there's going to be a lot to talk about, a lot of things to bring to people's attention. So it's pretty exciting. Before we get started, let's introduce ourselves. Erik, could you introduce yourself and what's going on at your company down there?
Certainly. My name is Erik Gebhard, and we trade futures options primarily. We use a algo-driven technology solution to select our option spreads. And we're primarily doing this on the E-mini markets. So that would be the stock index futures. And a lot of what we do is what you might call non-directional strategies where we collect premium. On the other hand, we do have the algos generating directional signals as well, which have come in handy in the last month. So certainly we take market direction into account when we feel volatility warrants it. And we've been doing this for maybe 7-8 years, specifically with our technology, but I've been registered and licensed since 1991. So we're AltaVest, and we've been doing this quite a while. So thanks, Jim.
Sure. And we'll get into some of the particulars on your strategy as well. Michael Filighera, give us a little update on what's going on with you and Logical Signals.
And good morning and good afternoon, everybody. I'm Michael Filighera. I've been trading since 1979. I started as an options market maker. I've traded on several exchanges around the globe. Currently, I am trading again from a home office, and I have switched, and I am now a day trader in the futures markets, in the equity futures markets primarily. And my primary markets right now are the S&P 500 and the NASDAQ 100.
Okay. All right. We're going to get into all the different things that are going on in the world here, so people get a nice broad view of what's going on economically, both here and abroad. And we're going to start out with our Monday morning question, which is the S&P 500 opened, and I'm using SPX, which is the cash, at 45.05 today on the opening. And the question is on Mondays, what will it be at on Friday? Up, down, sideways, and then what's your conviction level? Is it higher than 50-50? Is it lower than 50-50? So starting out with Erik, we're at 45.05 as a reference point.
Right.
Friday, how are we going to look?
We're going to be lower.
Okay.
We're going to be lower.
Your conviction is about percentage?
I'd like to give this one, I'd say 60% plus.
Yeah, a little more likely than not.
Yes.
Gotcha. All right, Michael, how are you feeling on this Monday morning?
I kind of came in with a 50-50, as I talked about in my updates. I make updates on Sunday. And I said, if the market is going to move higher, it needs to accelerate and get it done. If the market's going to move lower, it needs to accelerate and get it done. So based on how I've seen the market trade, say from the last half hour on last Friday, and then again this morning, I am going to say lower.
Okay, so lower by Friday, your percentage?
50-50 right now, based on, because I haven't seen it accelerate in either direction yet.
Yeah, no, believe me, it looks like a 50-50 market because it's been as high as 45.20 on the cash, down as 44.80. And right. According to what I see, it's right about in the middle of that. So
exactly.
Yeah. Okay. So what factors are you kind of thinking are big fundamentally or technically right now that people should be kind of focused on? Things coming up. Obviously, we know Thursday is going to be a big CPI situation, but anything else or anything that you're looking at fundamentally or technically that you think is very important, Erik?
Yeah, certainly. We're looking, in terms of a number, by the way, I think, I think somewhere around 42.50 is quite possible. kind of testing where we were not
Yeah.
too long ago on the
Right.
chart there. But, I think the market seems to be choking. You have these elements and these moments or periods of time, I should say, where you're looking at, we like to look at the VIX, and not only that, but the VXN, which is the NASDAQ VIX as well. And even looking at the Russell and I believe it's RVX. So, those are what we would call not really investable right now in terms of the signals from the volatility side of things. And, with that being said, looking at the Fed and what they're looks like they're planning to make a mistake. And, who are we to question the Fed? I guess maybe some people think that these people know everything, but as it turns out, they don't.
Right.
And, they're backwards looking a lot of times. And some of what they do is political, of course. And, inflation is, they denied it for, a long period of time, calling it transitory. I guess if you say it long enough, everything's transitory. But, now they're looking to hike rates, and meanwhile, the economy is slowing. The non-farm payrolls were a big number Friday, but still, that's kind of a bit of an outlier. You still have all these other economic factors decelerating and or peaking, other than crude oil at the moment,
Right.
which is really kind of an animal on its own right now. But
Right.
so, it just seems like without even looking at the technicals on the chart, there's a lot of macroeconomic variables and factors, and even looking at sort of the volatility elements where, there's really no legit price discovery going on. There's so much concentration of risk in the markets and some of these major ETFs, some of the ETFs that have,
All the same
XLK?
stocks, all the same stocks.
Yeah.
Yeah.
Well, XLK has Microsoft and Apple.
Right.
Actually, I made a note of this mentally. And the other one is XLY with Tesla and Amazon. And both of those actually, both of those ETFs, those two stocks represent 40%
Yeah.
of those ETFs.
Yeah.
So anyway, it's just not a normalized scenario. And of course, what is normal? But anyway, we could go on and on about that. But
No, I think
just,
I think what you're saying is obviously we're in a situation where we've never really increased the money supply by 35%. So obviously that's a factor. And we've never had the balance sheet up at 9 trillion. So people try to extrapolate into other time frames, but what you're saying, it is conceivable this could be a little different because the numbers are simply off the chart.
Yeah.
They're way off the chart, and it was something, all the money that was ever created in the US, and some crazy percent, I forget the number, something like 40% of it, or 50 or 80% is created just in the last several years.
Right.
I mean, don't quote me on those exact numbers, but it's something outlandish like that. But nonetheless,
and then the other thing, I'm sure, Eric, on a personal note to you is as you go around Orange County, California, you have a very hard time thinking that anything is going to be going way down in price.
Right.
Because every time you go to a restaurant, I'm sure there's a very long wait. And I'm sure that the prices are not going down. And I'm sure when you look at your real estate, it's not going down.
Well,
Your gasoline is $5.
Gas is over $5. And I just
So,
saw a brief headline 20 minutes ago about, I think it's Tyson Foods, poultry, meat, whatever, they've doubled in the last year. The price of those items have doubled. And meanwhile, the Fed was telling us all along there's no inflation.
Yeah. Yeah, I figured out it's better to gas up your car on El Toro Road than it is on Coast Highway in Laguna Beach. I figured out.
Oh my God.
Right.
Little variant in price there, So yeah, I get you. I'm with you all the way. With regards to Michael, do you have anything that you're seeing technically or fundamentally that you think is going to be very important?
Yes, I do. Technically, the S&P, I believe, did top. And on an Elliott basis, it topped some major long-term advances at 4808. And so I do believe we're in the initial stages of a much longer-term corrective phase than what the market is actually looking at. And that doesn't mean that we're going to go straight down. As I try to tell people, there will be plenty of trading opportunities in both directions. And what really I believe needs to take place now is that investors and individual traders need to take a look at what do they need to protect should we have a major correction down. And I'm talking about a correction that could clip 50, 60% off of prices. And what do you need to protect, and at what kind of size do you need to protect? And that's the decision I think that people need to make now. As far as day to day, I think that what we've really got hanging over us is, I'm going to piggyback on some of the things that Erik said, is that we do have interest rates. And the fact I do think that the market is beginning to understand and grasp and accept that higher interest rates are not only necessary, but they're going to happen. And whether or not the Fed wants to play its game, it's like, well, we'll kind of hold off and we'll do it in March instead of beginning in January, which I believe they should have, to just kind of ease everybody into this situation. So we get that big blast, and then we get the earnings from Amazon, which blew the doors off. And I think that what people tend to do is they can't grasp a bearish attitude because it's just, they feel it's unpatriotic or whatever.
Well, we haven't really seen any sustained drop in 10 years. You know what I mean?
Well, that too.
Yeah.
You're right. And so what I think,
after 12 years of it never sustaining a drop, you can understand
Well,
why the
that's
prejudice
true.
would be to the upside.
and the only one that we really had was March of 2020. But even
Which
on that one,
really was right back in their face. Not too long.
exactly, that's true. But I think more important, what I think we need to really understand is from that one, that when the panic does hit,
Yeah.
the NASDAQ lost 38% of its value in 3 weeks. And if we get something going now, it's going to be on something much larger than the reality of, oh my God, we have a pandemic. And so if we're going into a higher inflation period, which I think that's why you said we're waiting for the CPI numbers, because we need additional confirmation. And I think when we get that, we're going to see mass exodus in the marketplace again, and that'll kick it off. And we still also now, above all of that, whether we want to pay attention to it or not, my own personal analysis, I don't. My personal analysis is technical. It's not fundamental.
Right.
But the technical picture does tell me this is direction that we're going. We should be correcting. And then you can fill in the blank. And that blank might be that, they're amassing troops around the Ukraine, the West and the East. Everybody's going right there. And what happens if somebody pulls the trigger?
Right.
And how severe will it be? So these are the unknowns, and that's what we're trying to deal with. And I think right now, really what we're coming through as well, as we have a lot of funds and just traders who are reallocating. We're seeing a pretty strong exodus out of tech and out of the big titans of tech. And Facebook has really put a sour note within that entire sector. And that stock continues to get pummeled today.
Yeah.
It's down over $11 again today. And so I think there's just been a big shift in where they got to go.
Well, again, don't you think that's reallocating? In other words, if you used to have 5% in Facebook, and now they've announced they're going to be gambling on this metaverse where they have no idea what kind of revenue is going to come out of it, and their subscribers are stalled, and and other factors as well, then it could be a situation where it's just rebalancing going on. And that's a hell of a lot of rebalancing, because Facebook is like totally into every ETF in the world,
I agree. And yes, I do. That's exactly what I'm saying.
Yeah.
I think there's a lot of reallocation. Absolutely.
But they got
correct.
3 billion people who look at it, and 3 billion people to monetize is nothing to sneeze at, right?
I agree. And then but the next question is like, where are they reallocating to? And that's where I piggyback again on something that Erik said. I think we see a lot of, particularly in the Russell, where they're going into the mid caps, they're going into where they might consider value. And then you've also mentioned this in the past, Jim, yourself, that when we start to look for, if we're looking at inflation, where do we have to do? Where they're going to start pulling it out of these overvalued stocks, and now they're going to go looking for value. Where can they get value if we're going to have a correction? They want income, so you're going to have to go to the dividends. You're
Yeah,
gonna
no,
put the-
right now they definitely want to see free cash flow and they want to see some dividends, because if they're going to hold on to a market that's not going up all the time anymore, they definitely want to get paid some cash flow, and they
Right.
want to make sure the companies are making money. So if they
Right.
if they can pay dividends, they got free cash flow. So those
Right.
are the two things, and that's why staples, dividends, value,
Right.
and the like utilities are hanging in there during this decline much better than everything else.
And I would just toss out, and I'd love to get both of your opinions on this one. I think that if interest rates do start to go up, how many people are just going to go, you know what, I'm just going to move it over into cash. And I see that money market rates are going to go up, or this is going to, you know, and they're going to start putting it into interest bearing instruments. I don't know. It's a
Well, you know,
possibility.
if they have if they're an insurance company, they have to make 6 or 7% minimum, they're not going to go into a money market account. You know what I mean?
True.
But I will tell
Right.
you the other thing that JP Morgan says, and they're they're obviously have some research behind them. They're thinking that a lot of the interest rate increase is already factored into the market. And if you look at TLT, which has gone from 175 down to 138, some of it is factored in already.
I see that as well. And
In other words, if they start
disagree.
hiking a quarter of a point and that's all they're going to do, this thing is going to snap back big time, because this kind of a drop here is not discounting a 1/4 point hike, you know?
I agree, but then again,
Yeah.
I'm gonna piggyback on something that Eric mentioned, and you also have. They're behind the 8 ball right now. The
Yeah.
Fed, that now they're painting themselves into a corner, and so we're all expecting a quarter. What happens if we get a half? What happens if we get 3/4? Because what happened if
Well, we're
that
at
CPI
zeros,
number-
or we're at zero. So, I mean, frankly, let's be frank, when you put it in perspective, a quarter or a half, if you're at zero, is certainly not going to get people to not buy a car or not buy a house or not do something. You know what I mean?
Mortgage rates, well, I don't know about your particular area, but mortgage rates out here have gone up over a point.
Yeah.
So they said they were like at 3 1/4, and they're now at 4 1/4.
Oh, yeah. The
And
giveaway,
that-
I mean, the 100% giveaway numbers are gone. That's for sure.
Right.
Yeah.
And really what happens when that happens, I mean, you can do the math.
Yeah.
And, you know, if you particularly, I live in San Francisco.
Yeah.
So again, you know, we're
Mhm.
talking about trying to buy a house for $400,000 does not exist.
No.
Trying to buy a house for $1 million, you're going into a neighborhood that you maybe do or don't want to live in. But if you consider that if interest rates have risen that much, it's adding between $1,200 and $1,500, maybe even $2,000 on your monthly payment.
Yeah, no, there's no doubt. Hey, listen, we've seen this movie before. Rates go up, your payment goes up, the prices come down. That's going to happen over time.
Right.
But, and that's probably what they're betting on as far as the inflation. You know, the oil prices, they go to 100, and then all of a sudden, they
Pops the
start
bubble.
bringing more oil on the thing, and it can't last. And then if these
Right.
housing prices are way up here and they raise interest rates, the higher prices can't last. So that's
Right.
why some people think in the second half of the year, we'll see quite a rollover in the inflation rate. And then if that's the case, going past 2 or 2 1/4 on the 10 years, just not going to happen.
And I'll tell you what, even on an Elliott basis, that fits my analysis perfectly. We get the initial leg down, then we're going to have, and because of the size of the correction, we're going to have a really sweet rally. And I am looking for that rally second half.
Yeah.
Second half, like third, fourth quarter. So yeah,
Eric, you are focusing on the S&P, which we'll get into in a little bit. But are there any other markets that you're looking at outside of it? Because commodities in general, I mean, the CRB has been banging to the upside pretty good. I mean, I got a mutual fund in commodities. It was up like 50% last year.
Right. Yeah, certainly, we follow the key metrics and the key markets and key commodities. So, we do keep an eye on crude oil. We do have some small exposure in the crude oil market at times,
Right.
and using our option strategies and our solution, our platform. Also, also gold.
Mm-hmm.
And I don't know if you want to, let's see, what are we looking at here?
Now,
Looking at-
on gold, I've been a very big proponent on Newmont Mining since it was $52, and I see the action today telling me breakout. Could be false breakout, but if it gets above 65, it's no false breakout. And I'm very, very long this thing because it pays 4% dividend from where I got in. And
Oh, wow.
This is just, I think this was a no brainer, 53, 54 bucks and 4% on your money for an allocation into gold.
No, absolutely. I didn't realize that about Newmont. We don't really get too deep
you don't get
into
into the stock.
individual.
Yeah.
I mean, obviously I do my best to follow things like some of these ETFs we mentioned, and we talk,
Right.
because it's all sort of everything's interconnected. You have the inter and intra-market connectedness and so forth. So it all kind of works together. But yeah, that sounds. If gold, we're also for the record, we've been bullish gold for about a month now. We think it's going to continue higher in this environment. And, certainly in sympathy, you could see something like Newmont continue to trend well, trading above. Looks like, what is that, an exponential moving average there?
Mm-hmm.
Yeah. So, but, a market like, kind of back to what, Michael, and you were chatting about too, the Fed, they're going to look at this, the CPI print on Friday. And if it's a barn burner, I mean, that all but guarantees, I believe the Fed funds market is discounting just over 5 rate hikes this year.
Yeah.
And, it may be that if this print on Friday is even bigger than expected, everything is always based on expectations and consensus, of course. It doesn't really matter necessarily what the actual number is. The market's kind of discounted that moving into it, at least in theory. But, you're going to have a scenario where they're just absolutely compelled to follow their their line, which is to continue to hike into a slowdown. And the market's not going to like that. So I think that's something to be aware of. And everyone's going to head for the exits at once when this type of thing happens.
Yeah,
I've seen it before, more than one.
Mm-hmm.
And you have the institutions and the hedge funds and so forth that are going to beat the retail person to the punch, just the way it works. So, you're gonna be either wanting a lot of money in cash, or you're gonna want to have some downside protection. You might want to consider. I know there's some short inverse ETFs and that type of thing, but those are a little bit tricky too.
I
A lot of
looked at that. You're talking about that Dorsey one,
there's one. I know there's one
something
symbol.
SH or something.
There's one
DWSH. Yeah.
Yeah, there's a few fund companies that have their inverse ETFs, but one of them is SDS. I know that symbol, SDS. But the thing is, I think they reset every day.
Yeah.
So they're not really meant to hang on to. They're not a, what do they call it, a hodler type of position. But
and it's hard to explain exactly what they do.
Yeah, it is. I think they're just basically using options, quite frankly. But I think a better way is just directly buy some puts or buy some put spreads.
Yeah.
And you could even maybe try to sell call spreads at the same time on rallies. Fade the rallies. Sell your calls, buy your puts, and that puts on a position where even if we go sideways and chop around, you're still not in the red. The only way you get really hurt on that, of course, if you get a screaming rally.
Yeah.
So yeah, we like things like that, and it depends on what people have in their portfolio and what other positions they have. And I would just say this: I'm not a portfolio manager or a money manager or anything, but you certainly don't want to fall in love with your positions just because you bought some stocks and there was a good story behind them or a narrative, and you heard someone on TV or radio or on the webinar or whatever, pick various stocks, and now you're sitting on them at a 20% loss or 30% loss. I mean, that's you can't look at that and say, well, I don't want to get out now and take a loss. I mean, that's not really trading. That's having the market trade you. So you need to put your money to work.
I'm going to talk about something that we're both very familiar with, and Michael is as well. But here's my feeling, and I'll run it by you. The VIX went up to almost like 40. Okay. And we both know that when it gets up to 40, it can be a very, very important low point for price. And we hit 42.21. And when we hit the 42.21 and it hit 39, that was definitely a capitulation, at least to that point. And my feeling this year is either that's the low for the year, or if it gets taken out, then we could open up the door to the next level down, which is 3,800 and 3,500 stuff. But it's possible that 4,200 and that 39 print, may be it, because right now, from the moving averages I work with, this 4488 number is important. And if we start climbing above 4561 and 4610, that would put the idea, I mean, the longer we stay above 4,400 and 4,450, and then if we start climbing above 45,550 and 4,600, I mean, that's going to tell me that whatever the heck people are thinking, this thing may have hit the low there. And, there is a tremendous amount of money out there, and you live in Orange County, it. I mean, people are going to have money to spend like galore when it becomes spring and summer. And that's why, these travel stocks are interesting, because, people are definitely going to want to have some fun, and they got the money to do it. And so, I definitely hear that there's vulnerability. And, if he goes Volcker, I mean, then of course you're going to, anybody who's thinking about lower prices is going to be right. If he goes Volcker, meaning if he goes a half a point
Right.
and tries to get to 2% quickly, and then give everybody a jolt to the downside, and then it's over,
Mhm.
then I would be more thinking the 3,800 stuff and all that stuff might make sense. But if he goes Chinese torture quarter point in an environment with this much buying power and this much liquidity in the system,
Mhm.
there's some upside risk here.
Well, I guess my only comment, and I'll let Michael take this one, but
Yeah.
I think what you're saying is absolutely true, but it's also dependent on the landscape in which this
Mhm.
happens. And
Mhm.
right now I think is a different landscape than just even several months ago.
Mhm.
So you have a sequence of events, a series of events. You have deceleration and economic variables and rate of
Yeah,
change
PMIs and stuff
numbers.
like that. Yep.
Yeah, I
Yep.
mean, you have peaking and plateauing and topping and decelerating.
Oh
And
yeah.
then at the same time, you have, perhaps some of these geopolitical factors, which, of course, are
Yep.
more of a narrative story. You can't really, that's
Yeah.
pure speculation there, but nonetheless, so I think it's just really dependent on the environment that we're in which this type of thing happens. And I think you can say, well, the market expects, these rate hikes to occur. It's discounting it, and then people are going to, come back to party and fill up the punch bowl again.
Yeah.
And that's certainly always possible. I mean,
Yeah, because
you
you've been
never
in it
know.
long enough to know you have to be respectful of both sides of the pancake. Your opinions on one side, and then the other side of the pancake, you have to have some respect for as well. Yeah.
Yeah, well, I mean, if we could all count how many times we've been, incorrect about making a market call, then I
Right.
guess.
Yeah, no, yeah. I mean, like I say,
Yeah.
but you feel a lot better if you're incorrect, if you at least had some respect for the other side of the coin. You know what I mean?
Yeah, and also protection against
Yeah.
your position. You don't, you certainly don't want to take these, outsized risks
Yeah.
with any position. So
Yeah.
anyway, that's my
And with
thought on
going, but I really was kind of, what is your feeling on that 40 VIX? I mean, either A, we're going to blow out the 40 and go to 50 during some type of a crash, because that's the only time you get above 40 is if you have an 08 or a 2020 or something like that.
That's right.
And so we're not going above 40. So if we're not going above 40 unless we have that kind of an event, is it possible maybe they make a new low, but the VIX doesn't make a new high? And that's a diversion you could actually maybe buy into later this year?
I think if we're at this point in this landscape, in this environment, our position is that if you have the VIX up near 40 again, that is not a buying opportunity.
No. That's exactly. That's what I'm trying to
Yeah.
say. If it goes back to 40, then we're looking at, an acceleration to the downside. That's going to be into that 30 or 38, 3,500 kind of thing.
Right.
If you see better than 40, I think those numbers of 38, 3,500 make a lot more sense.
Certainly.
But right now, we only deal in the here and now, and in the here and now, it doesn't seem like that's extremely likely, because everybody is looking for as much as 9% print on Thursday, and everyone is looking now for, I mean, when somebody's saying there's 7 hikes coming, you know, if you have any respect for that, you've already taken your action on that.
Right, you've discounted that.
Yeah. And if you think the print might be 7 or 9%, you probably have already discounted that. And maybe they're starting to do that with Newmont Mining and the gold.
I agree.
But the point being is that, you know, we saw prints can be weird. Like the unemployment print was very weird. It wasn't weird to me because, you know, stimulus is gone. You know that the stock market gains are gone. So anybody who was living off stimulus and stock market gains has to go back to work. And that's
Yeah,
where
that
those,
was
that's where
that was
those numbers are
unusual.
coming.
Yeah, that was unusual too, because they revised the prior 2 months
Right.
dramatically upwards. And
Yeah,
I think it was
because
something like
but-
this revision was the largest in
Yeah.
scale of magnitude of any time,
Yeah.
I believe, and even the miss on Friday.
Because they said there's 2 million jobs still out there missing. Well, obviously those 2 million jobs are coming back now.
Hopefully.
Well, I mean, 500,000 last month, and then I read, you know, they're obviously coming back. That 2 million number's got to be coming down. But again, it wasn't so surprising to me because again, the logics of people having to go back to work when the stimulus runs out and when the stock market speculation is gone, you know, is not surprising. So they're capitulating to going back to the job, even if they didn't like it that much.
They can't make money on the meme stock so easily.
That's, I mean, I think that's the simple, very simple explanation of that.
Right.
Michael, let's turn to the gold and see if we can take a look at the chart. And, you know, it's been basically in a range 1900, 1700 for a year. So the question is, I mean, you know, there you go. 1700, 1900 for the last year.
But I wanted to just thank you so much for bringing back Newmont, because for the life of me, I've not been able to really figure out what keeps holding gold in this box that every time we talk about gold, I said, it's not moved out of the box yet. In fact, it's even getting tighter in the box. The box is now, it's really tightening up to like 1879, 1880 on the top and 1750 on the bottom.
Yeah.
So it's even getting tighter. So that could be a coil.
Now, my question to you, though, I'm going to refer back to history because, you know, we're been around the block. We've seen history before. Is gold staying here as a waiting game to see exactly, because, you know, talk is cheap, exactly what the Fed's going to do? And if the Fed comes out with this quarter point stuff and they remember, you know, how gold did during the Volcker thing when it went from $200 an ounce to 800, which means it went up 4 times in value.
Yeah.
And it did that before he started the aggressive hikes that made it go down.
That is correct.
Right. So if this guy comes out with this water pistol thing on a blaze of inflation, he comes out with this little water pistol.
Yeah.
Is this stuff going to fly at that point? Because, you know, once they see the whites of their eyes, meaning exactly what they're really doing, is this stuff going to fly? And if he comes out with a half a point and a more aggressive posture, is that what's going to take it to go down? I mean, what's going to decide to get this thing out of here? Because we already got a 7% inflation print, which with interest rates at 0 in money market, this thing should be at 2,200.
I agree. And first of all, Jim, I love your analogies. I love how you put things together. It just always gives me a little chuckle. But the underlying truth of what you're saying is, I think, is what's important. And I agree with you. And again, looking at gold, if I feel that we're forming a coil, so think of it as a spring. And so you're right that I think we're just biding time here, and gold traders are just biding times until they can get a clear, decisive decision on what is going to happen. So I think you're right.
Because Powell is talking out of both sides of his mouth. Let's be frank.
Well, Powell,
he's saying he's going to be, he's saying he's going to be measured on one hand, and then he's saying, but we may be very aggressive on the other. So how do you get anything out of that guy's direction? I mean,
I think, well, we don't. Out of him personally, we don't. But the numbers can't lie. So I think you're right. It's like we got reports last week that really were showing 7%. If we see CPI coming up and we see that it's taken another big jump, then I think that we're going to get a stronger reaction out of gold. And if they don't, like you said, if they come with this, well, we'll raise a quarter and let's see what happens.
That's a joke.
It's not only is it a joke, I think they're going to get the reaction they don't want. You know, in other words, it's going to be like.
And I tell you something that would also be very, very stimulative to the stock market. because frankly, the stock market is discounting 7 full hikes. And, that's for the whole year and into next year. I mean, this stock market is not going to worry about, quarter point hikes going out till way next year.
But the thing is, it's like
these companies are going to make a ton of money again this year.
Well, that's putting a lot forward to say that's a big if. But I agree with the sentiment underneath it. I agree with how the interpretation will be received.
Yeah.
So I see everything that you're going on, which could also explain, this coil effect that we got going on in gold. If they come out and just kind of, do something just so unexpected, like, oh, well, we're not really that worried about it. It's like, well, you're trying to appease somebody. And I really do believe what they're trying to appease are the investors, are traders who are now saying, it's like, you've got to let us know, because if we pull the plug on this bull market that's truly been in force since 1932,
yeah,
you can go back that far. Not that I'm that old, but you can go back that far. But definitively, it's been strongly in effect since 2009.
Yeah,
since that decline, we've done nothing but gone up. So every little drop we've had in between has been nothing more than a correction in an ongoing bull market.
mm-hmm.
So what are we looking at here? That this decline off of what we've seen in the S&P at 4808 is just a correction within an ongoing bull market. And you know what, Jim? It can be. It can
Believe
be.
me, there's more, shall we say, interest from the Fed and the government to keep the thing steady. That's why, again, in the beginning of the year here, when
Right.
people are reinvesting their pension plans and reinvesting all
Right.
the 401k money,
Right.
it's very unlikely they'd want the thing to be tanking. In fact, now that they brought it down a little bit, at least people that are coming in are geting a cheaper price than the 4,800.
So again,
After this period goes by of this reinvesting of money, that's another thing that might be keeping the thing, stable.
I do not disagree with what you're saying, but what I would add is they are now, so they're going to protect these people that are putting the money back in based on a lie, based on
no doubt
fib,
about it,
based on an untruth. So I will reiterate, if that's what happens, yep, folks, play along. Do not try to fight the market. If its intent is to go up, and that's what I'm talking about today.
That's I think very important to say, because again, when things got hot, they created 14 facilities so they could buy everything from mortgages to junk bonds to everything else.
Yes.
So the level of what the Treasury and the Fed will do to keep the game going has no real limits.
Right. I mean, if there's
the plunge protection team.
Exactly.
Exactly.
I mean, when I heard, I didn't know because I'm familiar with the 1913 Fed Act, and the idea of the Treasury setting up facilities and then the Fed furnishing money for those facilities, which keeps them in compliance with the 1913 Act. I just thought that was very creative.
Right. But to me, it's like, I do not discredit or say no to anything that you're saying, Jim. And that's why when we first were talking about the S&P up or down, my point is that if it's going to go up, it needs to accelerate. It needs to accelerate and tell me it's going up. But when it does, you're opening the path. And more succinctly, if we look at the NASDAQ, if its intent is to recover and go up, it needs to fly, it needs to go. And if it does, you're opening a door for the NASDAQ to go to new all-time highs. Now you put that against what we're seeing in these tech stocks.
You see this QQQ, the way I'm seeing it is if it gets above 360, 380, it's on its way again. And on the semiconductors, SMH, if that gets above 275, 295, that's on its way again. So this is no time for me. I'm not extremely bearish at all.
Oh no,
because,
I'm not.
Again, like I say, I've seen enough crazy things against what's in the news,
right,
to know that darkest before dawn is also a very it's an adage for a reason.
Right, but I don't think we can be overly bullish or overly bearish.
No,
because we're sitting right in the middle, and it's like,
right.
Folks, when things cease to be fundamental, when they cease to be, then you got to go to the technical, and the technical is leaving open a big wide door for this market to drop out of the sky or continue its trajectory to the moon.
Your RSI here is interesting because this could just be a little bit of a calm before the storm because it is under 50.
Right.
And if this thing started to take out 260 and that
We're-
RSI
we're-
starts
yes.
pointing down,
Yes.
we're definitely you're in the soup. So this might
Right.
be, as Eric, as an options man, it might be something to look at a strangle or a spread, what a butterfly they call that, a long
Actually,
butterfly.
I would look to be doing some strangles or straddles.
What do you think, Eric?
Certainly. Even sometimes we've bought, instead of selling iron condors, you can buy iron condors if you're sort of at a crossroads. And that can work. You get an explosive move one way or the other. Sort of in a
Premium,
yeah, inexpensive way to have a position, but you need a big move in one direction.
Yeah, you would. But if you went to if you went to March and you encompassed the Fed meeting,
absolutely, and you can, the VIX isn't really, well, where is the VIX today?
20 some
low 20s.
Yeah.
Yeah. So I mean that's kind of a normal, if there's such normalized level at the VIX at the moment. So your premium is relatively reasonable if you want to buy some premium on something like that. And looking at the RSI you mentioned on the QQQs, it just reminded me of the RSI on the SPX a few weeks ago when we were let's see, was it at like 24, if I can recall? I mean, 2 weeks ago, right before, well, was it? No,
Yeah.
not even 2 weeks ago, right before
Wow.
we, yeah, right there. I thought that was, I mean, that's kind of obvious in hindsight, but
yeah, oh no, yeah, it hit right against it. And like I say, I don't use the RSI as a Bible, but it's certainly a indicator. You'll notice when we're rallying, it generally is above 50, and when we're in a down thing, it's generally under 50. So that's just that
So
alone.
where
is
are we
not
sitting?
bad.
Middle in
but
the
I
road.
like to use it. Like if you look at the green, well, what's the date there? Well, the low, that low there with the green candle
Mhm.
and the
Mhm.
tail there,
Mhm.
and you see where the RSI is, and then you see 3 or 4 days later, the RSI is even lower, but prices are now higher. So you
Right.
kind of have that divergence between the indicator and the price, which played out in the next 3, 4, 5 days.
Yeah.
Right.
But
I was going to
That was
ask
the
you,
PPP
Eric,
story.
let me ask Eric a quick question on the option strategies that he uses so people get a little flavor on his methodology. When I have done credit spreads, I would either have a number involved, like I want to get a $1 credit, and I would go as far out of the money as possible to get that dollar.
right,
Or I would look towards my moving averages, and I would say, and the high lows and the moving averages,
right. Look
and
at a range.
I'll use that as my parameters on where I would do my strategy. So do you tend to look at the charts or the moving averages or whatever and come up with support and resistance where you think that realistically there is a very low chance of ever getting tagged? Or do you have a number involved, like I want a $1 credit, and you just simply go as far away as possible to get that money?
Yeah, very good. In other words, how do you engineer it? Do you kind of move forward into it, or you sort of reverse engineer it?
Yeah.
Based on price parameters or valuation, or
Yeah.
when I say valuation, I mean the value that you want to receive.
Yeah.
So we kind of created a formula, an algorithm, so to speak,
Mhm.
that takes into account just a lot of the standard approaches to options trading. So we're looking at the level of volatility. We're looking at proximity between the current market and the strikes.
Mhm.
We're looking at the value or the premium received,
Right.
and so forth. So all those things kind of are weighted in so many words, and
Right.
we come up with the answer. Like for example, today, if you're looking at a on the E-mini S&P 500, I'll just use an iron condor for an example. I wouldn't want to sell an iron condor right now for what it's worth, but if you're looking at a March into month, for example, I'm just pulling up one because any of the strategies are available anywhere from typically 15 days to excuse me, 60 days, 70 days till expiration. But so the algorithm is chosen to sell the 48.90 calls and 38.50 puts. So that gives you some idea in terms of the range above and below the market for that particular expiration. So in terms of what was I going to say? In terms of being more directional, of course, you can simply do what I suggested earlier is you can flip the condor around and just buy it.
Yeah.
Or you can simply just buy some put spreads, sell some call spreads, and the algorithm will help select that for you as well.
So you have software that kind of issues really, in other words, when I would do it, I would obviously just come up with my own thoughts. And in your situation, you're using software to give you the probabilities and you don't do it manually kind of thing.
That's right. We kind of
feed
the answer. We spoon feed the answer to you. And that way people don't have to spend time trying to develop their own spreads and kind of scratch their head and wonder if it's a good one or bad one or whatever.
And if you've done it for decades, you can do it in your head. You could do it, while you're driving home. But if you haven't done it before, or you have other jobs that take you away from watching things, the software comes in very handy.
Yeah. And in fact, that's probably I would say the more critical aspect of what it does is it will keep a person from having to kind of babysit and monitor the trade. So once you have the position on, it monitors it. And then when it feels, well, not feels, there's no feeling, when the numbers say get out of the spread, whether it's for a win or a loss, it'll generate that order for you.
The key it gives you, Eric, that cannot be understated is it gives you discipline.
Yes, that's exactly my point. It handles the management of the position.
Yeah.
So you're going to get out of that trade before expiration regardless, and it's going to be for a win or a loss.
Yeah.
And that way you don't have to I talk to people every day and I won't go on about it, but they're just, look, I'm a escrow agent. I'm a this, I'm a that. I don't have time to do this. And I say, well, there you go. This is why we put this together. And it really was based on feedback from all of our clients. Yeah.
And when you buy options, you're fighting two things, time and price, and time and price, wins more times than not. So that's why, this strategy as part of a portfolio is something that people look to.
Absolutely. Especially if you're kind of on the precipice here of a indecisive market and where there is potential for a large, the floor falling out for a bit. You want to, if you have a bunch of exposure and you're worried about it, then really your best bet is to protect it, use some option strategies, or simply just get out and go to cash and think about it later when you've got a clear head.
Well, Michael, before we run out of time here, let's get the Fibonacci up here, because last week you were very, very accurate. Fibonacci was talking about 45.85 up towards 46.31, I think. We went to 46.10 and totally fell out of bed. So obviously there might be something to it. So let's give everybody, and including ourselves, a little tip on what's going on with the Fibonacci's now.
Right now on Fibonacci to the upside, where it needs to start to break, it needs to break 45.13. Then it needs to break, come on, give me that number.
What's the 38 and the 61 numbers?
The 38 was that, it's not given, it's like, I gotta.
Because you'd be measuring it from a different point today, wouldn't you?
Right, what I'm measuring is for an upside move. I am measuring for what I would consider to be the wave up.
Yeah.
And the position that it's in is in a pretty strong position where to have to move up in like what I would consider an Elliott third wave. And that's where I'd see the acceleration.
Sure.
But that claims 45.13, 45.29, 618 is 45.50.
45.50 is the
no, excuse me, that's not 45.50, it's 45.35. But the 45.50, it definitely needs to break. And what my point is that if this is what this market is intending to do, it's got to break 45.86. We're back to those old numbers.
So last week we were at 45.85 on the low on there, and then you had something at around 46.30. So those numbers would have changed since last week, right?
Right, and those are the new ones that I've given.
So the new ones at 38% or 38.2 is at what number?
Is like 45. I'm trying to get this damn number up here. It's not telling me. So I can see it, but it's going to be an estimate like 45, 20,
45, 20, 45, 28. And then the 61 would be a ballpark of?
45, 36. That one did come up, 45.36.
Is this a
That's at
measure?
61.
Is this a measure of the last drawdown from the highs down till
No,
February?
no, it's a measurement where I'm going from the low at 44.38 to the high at 45.32. And then I'm
Okay.
taking it back down to the low that we did early in the week at 44.71. So I can project what the next upside move could be.
But last week they were 45.85 and 46.31. Why would they
Right.
be so much lower today? Is it because the market has come down?
Oh, it's just at different points that I'm connecting.
How about if you started from the point of last week?
From the point of last week, those were for downside numbers.
No, they were upside number
I know, I gotta
45.85 and
redraw. Let me
46.31.
redraw. Let me redraw.
Yeah.
And then I will be able to give those to you very cleanly. If we were to continue upside and we're just going to mark it from the high at 47.39 to the low at 42.38. Oh, no, excuse me, 42.12. Those numbers suggest much higher. In fact, we have that other number of 45.86, and then it starts to break higher. Then we're talking 46.39, 46.67, 47.
So those numbers have gone up a little bit since last week.
Yes. Yes.
Is
they
that an
have.
indication of a trend or indication of anything? If the numbers,
Well, that's what we're sitting in the middle of the road of.
right?
So I think it's like, and you're right, I'm waiting for the market to tell me where are we going to do? Are we going to, if we're pushing higher, it needs to accelerate. That's what's going to be the giveaway. It's like, hey, they're just taking out resistance and they're going. If it's going to move lower, it's got to do the same thing. That's on an Elliott basis, it's sitting right at a point where it's like either you accelerate higher or you accelerate lower. Sitting in between and doing nothing
Doesn't tell you anything.
doesn't tell me a dang thing.
But I have two numbers, 45.61 and 44.88. So let's call it 45.60 and 44.90. Do you see, well, you can see the yellow line comes in right there. So if we started closing underneath down toward 44.50, that wouldn't be very good, would it?
No.
And then if we closed above the 45.61, which would be above the 45.50 area, it still has some resistance there on the blue line, but it could also be in the, because, you know, some people think that a market that goes up, pulls back and stops pulling back is going to go after that high.
I don't disagree
Harry
with
Boxer
that,
is a
but-
big, Harry Boxer is a pretty sharp guy, and he's very much a believer of this
And
kind of
Harry,
form.
and I've talked with Harry, you know, we've been on the show together. And so
Yeah.
I don't disagree with them, but look what it's doing. It is not doing anything.
No,
So
but if it
again,
started to do something, you know, you might
did.
want to go with it.
and it did, and then it fails.
Yeah.
So again, that's why I'm using 45.19 at the top, 45.13.
Right.
If it breaks above that, it should start to accelerate, then
Right.
get above 31, then get above, 37 to 40.
Yeah.
Then you're like, we're off to the races.
So
And
real
then,
quick,
on the downside, if it breaks 44.45, then it's heading for 44.13. And if it breaks
Or
that,
hey, listen, believe me, or a lot lower than that.
all right. But I'm just talking, these are steps. It's not just.
Yeah. You're talking on a very short-term trading thing. You know what I mean?
I'm on an hourly chart. So it's
That's what
not
I'm
that-
saying, on an hourly chart.
so
The guy-
Michael, real quickly, are you looking? Sometimes you look for a close above or below. Do you like to look at 2 consecutive closes or 3, or just 1 is enough?
I would look for those closes above the moving averages.
Just
And the
one,
moving
yeah,
average
just
right
one.
now, it is sitting and waffling around the hourly 200 moving average. And it keeps trying to pop itself back above the 50 and the 20 moving averages. So they're all bunched together.
Right. I just
So-
was making that comment because I know sometimes people will say like, I like to wait for 3 consecutive closes before a signal is confirmed, but sometimes you wait for 3 consecutive closes on whatever time frame you're looking at, and the market's already taken off in whatever direction it's
I
gone.
agree with you on that.
Yeah.
I definitely agree with you on that. And for right now, I mean, I use a combination of Elliott, Fibonacci, and then the moving averages. Moving averages are very, very clean. And right now, the 50 is flat on an hourly chart. 50 is flat, the 200 is flat, which is telling you it's doing exactly what it's doing. So for the upside, I need it to stay above the 200, which is right now sitting at 44.86, 84.
Yeah, that's the number I got.
And so, and then I got the 50 up at about 45.96.
Mhm.
So if it can break above 44.96 and stay above
Right.
and give us a close above that, then I think we start to see that just gives support for more buyers to push in. Conversely, if it goes and drops below that 200 and we get an hourly close below it, it's going to bring in a whole bunch of sellers because now they've got the support to sell. And then we're on to breaking 44.45, 44.13. Now, and again, we're not dropping into that black hole as we did before, Jim, because we do have some price support we can find if we just go back a week. But I think eventually, then I'm into agreement in what Erik mentioned earlier. We literally, if this thing starts to really accelerate lower and show its true nature of what this move is, on an Elliott basis, it's a third wave down. And then we're looking at below 4,100.
There you
So
go.
third wave from the high.
Third wave from 45.86.
Okay, so you've zeroed in a bit. Okay.
Oh, yeah.
Yeah, you can
It's
see from
already
the
done the
chart.
first
You
and
can
the
see from
second
the
wave.
chart there. We start closing underneath 44.80, 44.50. I mean, there'd be some selling coming in.
Yes, I agree.
And your RSI is obviously, or the patient has already got low blood pressure. You know what I mean?
Yeah, I told you come up with a great saying.
I try to keep the metaphors, going. You know what I mean?
They're great though. They're great because they're so true.
Yeah.
It's
All right. Well, let's
right.
let's let everybody know how they can get a hold of us and get these brilliant ideas right in front of them. So, Erik, just introduce yourself, and if you have any special offers, this is a good time to extend it.
Yeah, certainly. Well, if anyone wants to find out more about using some algorithmic options trading, it does sound complicated, but it actually takes something complex and makes it simple. So you can do two-legged spreads, three-legged spreads, four-legged, five. We do even six-legged option spreads.
Wow.
But quite frankly, we're doing these with just one click, and that's all it takes. And then once you have that position on, the system will automatically monitor it and follow it for you. So you can reach me, my direct number, 949-236-6961. You can send me an email, Erik, ERIK, at altavest, ALTAVEST.com. And of course, you can go to our website. We do offer free demo accounts. Altavest.com is our website. And you're more than welcome to call me anytime. That's my direct number, email, and be glad to chat with you about what we do.
Great. And thanks a lot for being here, Erik. Michael, again, a little reintroduction and how they can get a hold of you.
Sure. Again, Michael Filighera. I have two channels on YouTube where I do daily updates, one on the S&P, one on the NASDAQ. Those are both based on the futures market. And so that would be, if you go to YouTube, you look under Traders Helping Traders. Please be very careful because somebody else has pirated our name, which is trademarked. But look for my name under Traders Helping Traders, and then you'll get my updates. Please always just subscribe, and then you'll always get notification each day when the new ones are up. Right now, I am more focused on teaching and coaching because I find that more people want to know how to really do what I do and do what they can then do by themselves. So I am offering some great deals on coaching. You can get in contact with me by sending me an email. And that would be michael@mjf1partners.com. And that'll come to me. I answer all my emails, ask any question you want, and I will give more information on my coaching sessions. You can get that. I'd rather send you the email on how to get there because it's with Teachable and it's got a screwy little email address, not email address, but just a URL.
Okay. Perfect. And as far as Option Professor is concerned, we've got 5 PDF reports on income, growth and value, international investing. We're very much into the UK right now and the European banks. Also, we have one on options and stocks that we like Newmont Mining. And of course, we were with GBTC and ETHE, the crypto, right near the lows, and that's been working out great. And so you can get these PDF reports by going to optionprofessor.com. and putting in your contact information, and then we'll get back to you and explain how it works. So thank you very much for everybody being here today. We certainly, I think, gave a lot of good information out there, and we'll see how things pan out. Right now, I'm going to send it back to David. Again, thanks, Eric, and thanks, Michael, for being here, and we'll be talking soon.
Yeah, it was a
Thank
lot
you.
of fun. Thanks. Thank you for having me.
All right, thanks, guys. Yeah, a ton of good info today.
Yeah, thank you, David.
So yeah, thanks for being here. And so just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast app. You can also just go to TimingResearch.com, and the archive from today's show will be there as soon as I can get it posted. And you can also scroll back and find any of the past shows or events there as well. So I just want to thank my guests again for today. Erik Gebhard of altavest.com, Michael Filighera of logicalsignals.com, and the Option Professor of optionprofessor.com. Thanks, everyone.
Thank you.
Thank you. Right. Bye-bye.